right. So this is a tough act to follow. So thank you so much for putting me right after Mary Suarez. But thank you for staying here. I was in the back taking a few pictures and trying to make some connections, having help us more in the future. And he's very much into education, very much into helping FIU as an FIU grad and as somebody who knows the value of helping education. So I apologize for being here a little bit late. So this is the academic panel. And really what we do here is that we're talking about the kind of things that professors do between when they teach their classes. So a lot of you thinking, and I know I talk to my students, is that I'm coming to class on a Monday evening and I teach between whatever, 5:30 and 10 o'clock at night. And then they see me again the next Monday evening and it's like, so what are you doing between Monday and Monday? Are you like sitting at home watching Netflix? And not quite. I haven't been watching Netflix for a while. One of the things that I do, in addition to, a lot of you know that I do a lot of consulting and involved in investment, et cetera, but academic research is a big part of what professors do. And when we talk about research, when I'm asking you, hey, what do you know about this or that? It's like, well, I don't know exactly, but let me do some research about it. And what you mean by let me do some research about it is that you're saying, well, I'm going to go and I'm going to ask Google. Okay? Well, that's fine. That's one type of research. But when academics are doing research, it's basically we answering questions that the answers are not known. So it's basically we are asking ourselves questions that are interesting, that are, we believe, important, and then we try to provide answers. We're the first one to give those answers, and that's how we are creating knowledge over time. So what I'm going to do today, usually the research papers that we write are very long. They're like 40 or 50 pages long. And when you have a full academic presentation, it is very likely that the presentation will take an hour and a half talking about one topic, and a lot of math, a lot of equations. It's very, very, very boring, a lot of very dry language. I tell my students always, if you cannot fall asleep at night, please take a few of my papers. It will solve all your insomnia issues. You will fall asleep right away because they are very dry. So I'm going to try to make it, instead of one paper in an hour and a half, I'm going to try to do 3 in 15 minutes. And I already took 3 or 4 minutes, so I better get to business. So here's what I'm going to be talking about. The first one is about artificial intelligence and real estate valuation. Okay, so something about, from the technology side, artificial intelligence. Then I'm going to be talking a little bit about the art of pricing residential real estate. I know a lot of you here are working as salespeople and dealing with residential real estate. We are listing properties, and how to price it is important. And the third one is just give a little bit of an overview of whether or not the housing market in Miami and beyond is overpriced. Do I have a clicker? Okay, so the first paper I'm talking about, it's titled Boosting the Accuracy of Commercial Real Estate Appraisal with Machine Learning Approach. Sounds very, like intelligence, but it's really very simple. Really what we do is that we're looking at a large set of data, in this case, over 7,000 commercial real estate properties over some long time period, about 25-year period of 1997 to 2021. And what we do is that on each one of those transactions, we have information about what the property is in terms of physical characteristics, number of, square footage, things like, rent, NOI, occupancy, things that, tell us something about the value of the property. And then we have a lot of other things like locational. So we know from Google Point of Interest exactly where the property is located and what is around it. Is it near a coffee shop? How far it is from a pharmacy? How far it is from the local government office? How far it is from the railroad, et cetera, from the ocean, all those kind of things. And then we're looking at specific market data, which is what is the current cap rate in the market, what is the current GDP, what are interest rates in the market, and so on and so forth. So all this information, and then we train the computer. For those of you that know my background, my first degree was computer engineering, and now I'm professor of finance, and people are like, why? Well, this is where I use that. So you train the computer to shift to learn the data and train itself in order to find relationship between the data and actually the valuation of real estate. And we ask ourselves 3 questions. So first of all, can we actually accurately estimate commercial real estate values using a machine learning approach. Okay, so can we get some good estimations? The second one is, are those machine learning estimates more accurate than what we used in the past? So those of you that take graduate level courses using, simple regression, which it's good, but maybe not the best approach to value commercial real estate. And the third one is, can we determine which factors are most impactful when we estimate commercial real estate values? And I'll jump right into the results. I'm not gonna walk you through the actual methodology and all that because it's too much in the short amount of time we have. Basically, the accuracy that we get, or the error that we get, is about 2.71% from what properties are actually selling for. So think about it. We can have a model that is training itself over time and is estimating the value of the properties only about 2.7% away from what they're actually selling for. That is very, very good. In terms of improvement, depends on the property type. We're looking at about 16% more accurate than previous methods. So very proud of this. And there's still a lot more to do in this area. Machine learning is still something that's very young. There's always ways to improve it and make the machines learn better and use artificial intelligence better. But this is one of the first evidence that you can train the machine good enough to do better than what we did before. So yes, we can have those valuations. In terms of the factors that impact the values, we can split them out as you see there on the graph. So this is basically a list of different factors that will affect the price of a property at any given point of time. For example, occupancy and the capital expenditure in the previous period, the type of the property, employment in the area, NOI growth, etc. All those things, and it will tell you each one of them how much it does or does not contribute to the overall value of the property. So a lot more research to do that there, but I found it to be very interesting. And by the way, this research I'm working with 3 of my colleagues at Regensburg University. That's where I'm also a visiting professor, and we have a very good relationship with them. The second one, that is actually not a recent research, but I'm talking about it because I know that a lot of you are interested in this topic. So this is about how you price real estate, specifically housing. I'll get into that in a second. So basically what we're looking at about 370,000 different properties. You look at those properties, you have all the physical characteristics, where they're located, how many bedrooms, bathrooms, when they're built, location, all those kind of good things. And then we know how much they're listed for and how much they're sold for. And we try to learn or to get something from this data about whether the way that you price real estate matters. And what do I mean about the way that you price real estate? So when we're talking about pricing strategy, when you go to the grocery store and you buy laundry detergent, it's not priced at $13. It's priced at $12.99. And when you're buying, cucumbers, they're not priced at $4. They're priced at $3.99. And when you you buy a pack of gum, it's not $2. It's $1.99, and so on and so forth. And you ask yourself why? Well, there's a lot of research from the marketing literature that says that when you price a pack of gum for $1.99 or $2, you're going to sell more of that. And there's a lot of evidence for that. And the reason is because the way our mind works, even though we know that when we pay $1.99, we're really paying $2, still, the way our mind works is that you see $1.99, you're more likely to buy it, and that's why they sell more, and that's why they price it. The question is, does it work for real estate? And there's some reasons to believe maybe it doesn't work for real estate. Number one, because real estate is not a pack of gum. We're talking about very large transactions. Okay, not something that you spend $2 on, but something that you spend hundreds of thousands of dollars on. It's something that is not an impulsive buy. So, right, you don't just grab like you grab a pack of gum as you are checking out at the grocery store. It's something that it's an involved transaction. You think about it, you plan on that, you discuss it with your spouse for a few days, you shop around. So it's something that you think about more. So maybe you're less likely to be tricked by this $99. And also price deemed negotiable. So again, the laundry detergent is maybe priced for $12.99, but you don't go to the cashier and say, hey, I see you priced for $12.99. How about $11.50? You don't do that. It's like you either buy it for $12.99 or you don't. In real estate, when something is priced for X, it is okay to negotiate the price. You may be more or less successful depending on the market, but it's something that is acceptable. So because of those reasons, it may not work for real estate. We want to see whether it has an effect. And the question is that how these pricing strategies actually affect the discount to the listing price and the discount to what those properties are actually worth. So again, right into the results. So the title I put here is that it pays to price homes like we price a pack of gum. So most of you that listing real estate, you do price it with a 99 somewhere, and maybe you don't know why, and let me tell you why, because it works. So what we see here, we divide it into 3 different strategies. One strategy is for those properties that are priced at a round price. You price a property for 360, 570, 840, okay? So the third digit is a 0. The other one is what we call below or just below. So you don't price for 840, you price it for 839, 379, 569, and so on and so forth. And the last one that is not very common is those that we call it precise pricing. So where the third digit is 1 through 8. So 371, 573, 684, okay? Those what we call precise pricing. And what we see here is that when looking at how much those properties actually selling compared to what they're listing for, the smallest discount is on precise pricing. You see 0.69 is small discount. And that is because when you list a property for 371, it almost tell the buyer, hey, I'm serious, I did some serious research about my property, and this is what I want, and I'm not going to negotiate very much. So they're selling very close to that price. So that's the smallest discount. On the other hand, we see that when you're talking about what property is selling compared to what they're worth, and we have methods to estimate what they're worth, we see that the smallest discount, which is actually the highest premium, okay, so the selling above, is for those properties that are priced with a just below strategy. So they're selling for a negative 181% discount, which means a premium of 1.8%. If you compare discount, for example, on round pricing of 2.2, together you're getting about a 4% difference that you're getting more for a property if you price it for an 899 or an 879 or a 679 or whatever it is. You're going to get 4% more on the price compared to if you price it traditionally at a round number. And if you think about 4%, it's a big number, right? I mean, if you're selling a $400,000 or $500,000 house, 4%, that's $20,000. That's a lot of money for most people. So this is what we find. So yes, keep pricing your properties. Now you know why, but keep pricing your properties with a third digit as a 9. And then let me talk about the state of the housing market. How much time do I have? About 5 minutes. Okay, perfect. So a lot of people talking about the housing market being heated up. Prices, of course, are higher now than ever. So where are we going? So I don't have a crystal ball, but I do have a lot of information looking at that can give you a bit of perspective. So first of all, this is from a research I'm working with Dr. Ken Johnson, sitting right here, from Florida Atlantic University, and we publish that on the website monthly. So just some general numbers. So in the last 12 months, we saw price appreciation in the United States about 15%, and that's on top of about 19% the previous year. So clearly, very fast price appreciation. We know that. That is not a surprise. Housing prices now are the highest they've ever been, even compared to 2007, which a lot of people thinking about as the height of the market. Prices now are about 63% higher than they were in the previous peak of 2007. Okay, so clearly, in nominal terms, we are much higher now than we ever have. And a lot of metros are materially overpriced compared to the long-term trend. So we're basically running a regression. Where's Nick? Regression for you, somewhere, right in the back. I see you. We're running regressions in order to basically estimate how far we are relative to trend. And we see many areas that are 50, 60% above trend. So that means that they're overpriced. In many cases, there's a lot of reason for that, simply because of the tight supply in the market. But a lot of markets are clearly overpriced, at least relative to their long term. Now, if you're looking at places like Miami, ranked 38, that is not extreme overpricing. If you're looking at previous booms, we're right in the top 10. Now, we are somewhere lower. And then we have a lot of markets that are not overpriced. Actually, those prices that are not overpriced used to be very overpriced in the previous boom. So again, the mayor was talking before about California, New York, etc. A lot of those, without getting political, a lot of those places that basically shut their cities during COVID, they see their prices there do not go up as fast as in other places, and that's why there is not much premium there. So that's it in terms of just pricing relative to long term. However, this is not giving you the full picture, because it's just telling you that prices are relative or high relative to long term, but maybe they're not overpriced. So if you look at prices relative to rent, and rent is what fundamentally driving property values, you see that prices today are only about 12% above average. 12% is really not that much, especially if you're thinking about the fact that really we do have severe undersupply of housing. So this can be explained very, very easily. But it's not sustainable if interest rates are peaking, and I will talk about it in a bit. The case of Miami, because we do live in Miami, so you care about that, it's even more encouraging in terms of the premium we have. We're now only about 7.8% above trend, as much as we're supported by rents. That means that maybe price here is slightly higher than they should be, but that can be very easily explained by the fact that we have severe undersupply, that we build here in Miami and the rest of the United States less units than needed all the way since 2011. So if you're thinking about the last 10 or 11 years, we build every single years less units that are needed just by general population growth. And that accumulates, and that's a problem we're not going to solve next year. It's not a problem we're going to solve in 3 years, and I don't think we're going to solve in the next 10 years. We're going to have continuous housing shortage here to stay. So 7.8% is not a high number. So in these terms, I do not see ourselves as overpriced. We also rank only 76 out of 100 in terms of price to premium. So even if prices here are expensive, they're not expensive in terms of, if you compare it to other big cities. And there's a lot of good reasons of why price in Miami will be expensive. I mean, Miami over the last few years basically changed from being a second-tier city to a first-tier gateway city. There's no question about that. COVID, of course, accelerated that. So I do not see any concern there. However, this time is different, or is it? Or is it not different? There are many reasons to believe that even though prices are high today, things are different. So here are the reasons why I'm optimistic about housing prices in Miami, generally in the United States, but in Miami specifically. So number one, most buyers today do have material skin in the game. So it's not like in the early 2000s, people bought with zero down, fake financing, liar loans, etc. Now most of the buyers that bought properties in the last few years, they bought them with real down payments, real money, so they have real skin in the game. Secondly, housing units are severely undersupplied. Again, during the first boom of the early 2000s, we have oversupply of housing. Depends on the area they look at. We're looking at units that were, many areas that were very, very severely oversupplied. Now we're talking about undersupply. So we're talking about the fact that people really do not have a choice, and they have to live somewhere, and that supports housing prices in general. Then we have inflation that is still here, and probably going to be here for a little while longer, that is supporting housing prices, at least in the short term, at least in nominal prices. If you're thinking about it, and many people do not know that, housing is the biggest component of inflation. So when you see inflation is high, even when you strip commodities like gasoline and food and all that, that basically means that housing prices or housing costs are still going up. So this supports us, at least in the short term. And then rents increase along prices. That is something that we did not see in the early 2000s. In the early 2000s, when we saw the first boom of housing, we saw housing prices go up and rents stay the same, or did not move much. Because everybody said, okay, buying the house is the greatest thing on earth, let's buy houses, nobody wanted to rent. So that's how you create a bubble. You have prices that were high, not supported by rent. Right now, we have prices that are high with high rents, which is the fundamental support for the market. So this is on the positive side. That's why I'm optimistic about housing, especially in a city that is growing like Miami, an area that is growing like South Florida. On the other hand, mortgage rates are extremely high. There is no other time in the history of modern history that mortgage rates, doubled and more than doubled over such a short period of time, right? I mean, just a few months ago, you can get a 30-year mortgage for 3%. Now we're talking about 7. We never had that before. The market needs time to adjust for that. And we probably cannot see a return to normal in terms of prices continue to go up, at least in a significant way, until rates will calm and maybe will peak at some time. And those of you that saw me or heard me speak before, I have a prediction about that. And if anybody here from academia, they say, okay, you should not make prediction in front of 200 people, but I'll make it anyway. I do believe that rates will peak sometime near maybe the second or the third quarter of 2023, and then will start coming down. The Fed is now being very aggressive, especially in terms of telling the market that they keep increasing interest rates, because that is their job. They want market to cool down, they want investments to come down a little bit in order to fight inflation, so that's their job. But the truth of the matter is that at the end of the day, rates will come down simply because the market will slow, investors will go to some level that the Fed is comfortable with, and they will start declining, or the interest rate will start going down. I saw a graph at the Wall Street Journal, and I just finished with that just the other day. It was 2 days ago, I believe, and that is about the spread between a 10-year Treasury and a 30-year mortgage. And it caught my eye just enough to put here in the last slide. Historically, over the last 60 years or so that we have data on that, the spread between a 10-year Treasury and mortgage was about 1.8%. So 10-year Treasury, mortgage was about 1.8% above that. Now, we're looking at about 3.2% above Treasuries. Why? Well, many reasons for that. One of the most basic one is simply because the Federal Reserve is not buying those mortgages, putting down pressure on them. But again, at the end of the day, this will come back to average. So we're gonna go back from whether it is a 3.2 to 1.8 something in the next couple of quarters. That by itself is gonna reduce interest rates by about 1.5%. When will it happen? Well, first of all, 7% right now, 1.5% lower, that's 5.5%. When will it happen? I believe, and have reason to believe based on what I read and the things that I study, that it will start happening when the Fed is signaling that the economy is soft enough so they stop increasing interest rates. You're gonna see this gap between 10-year Treasury and the 30-year mortgages go back to normal. And then when interest rates go down a little bit more, you'll be able to get a mortgage in what we recently accustomed to be as a more, I guess, affordable level. So that is my view on the housing market. Hopefully you learned something about my research and the kind of things that we do before doing classes. Hopefully you enjoy that. And I guess who is next in line? Dr. Dickinson? Thank you, guys.
I think I'll use the microphone.
Okay.
Is this working? Yes, it is. All right. Good afternoon. Well, not only do we get to come after Mayor Suarez, then I, the newest member of the faculty at FIU, get to go after the head of the real estate program. So this is a little bit nerve-wracking indeed. But if we could, oh, I guess I have to do this. Oh. Okay. But anyway, thank you very much for the opportunity to present the results. This is actually the results of the research I did in support of my doctoral dissertation. I am a newly minted Doctor of Business Administration from FIU. Thank you. Thank you very much. So, you know, the main topic was crowdsourcing and customer loyalty. So you might think, well, wow, what are those? They don't really have much of a connection, but they do, as we will see. You know, I came to academia after almost 40 years working really mostly on the hospitality side of the commercial real estate industry. And I know that this question of customer loyalty is front and center for most hospitality companies. Most of the major global brands spend hundreds of millions of dollars every year on their loyalty programs, and they carry even more hundreds of millions of dollars on their balance sheets in the form of liabilities of unused points. And yet they're still not really sure whether their customers are loyal or not, or whether they're just customers that are sort of accumulating prepaid stays in what might be better termed as a frequency program. I would guess that most of you probably have the loyalty cards of at least 3 or 4 or 5 different hotel companies now, so you know, how much loyalty does that really exhibit? The idea for this research actually stemmed from an academic article that I read that demonstrated that customers were willing to pay more for a product and buy more of it at a premium merely because at the point of sale they were alerted that the product had been developed through crowdsourcing. And what caught my attention really was the reason why. And that was that customers felt a greater feeling of affinity. They felt more invested, if you will, in the product by virtue of learning that it had been developed by people like them. And so this struck me in a way as some sort of an expression of loyalty. And so I became curious as to whether the constructs of loyalty and crowdsourcing might share some psychological factors, some psychological drivers in common. So all good research, and especially if it's more applied research, it needs to have a so what factor, like why does it matter? And crowdsourcing and customer loyalty are two of the most salient issues in the US lodging industry today. And we touched on loyalty, but what is it precisely? Loyalty expert Richard Oliver defines customer loyalty as, quote, a deeply held commitment to rebuy or repatronize a preferred product or service consistently in the future, in spite of situational influences and marketing efforts having the potential to cause switching behavior. What about crowdsourcing? Many of us have heard of the term crowdsourcing, but the concept is still not that well understood. Jeffrey Howe is generally credited with coining the term crowdsourcing in a 2006 article in Wired magazine as, quote, the act of a company or an institution taking a function once performed by employees and outsourcing it to an undefined and generally large network of people in the form of an open call. So this notion of tapping the wisdom of the crowd through crowdsourcing has been greatly facilitated by the internet, and its applications range from conceiving new products like Starbucks coming up with a new coffee drink to solving really complex problems like open core software code and things like that, to crowdfunding, raising funds for big projects. My research focused on crowdsourcing as it pertains to new product ideation. So the key benefits of crowdsourcing and customer loyalty are superior product ideation at a lower cost, and sticky psychological loyalty really drives profitability. They estimate that anywhere between 25 and 40% of the profits of most companies come from the top 5% of their customers. And so driving that loyalty, and especially psychological loyalty, would be a big deal indeed. So a real solution could be a potentially strong 2-for-1. You know, what if lodging companies could secure the benefits of crowdsourcing and loyalty while lowering their cost simultaneously? And this led directly to my overarching research question. What effect does participation in product ideation crowdsourcing have on effective commitment as a driver of customer loyalty in the lodging industry in the United States? And get ready for the eye chart. Okay, this is my research model. And what it basically shows is that the 4 independent variables on the left side are directly and positively related. It has 8 hypotheses in total. And the first 4 are that these psychological antecedents are directly and positively related to product ideation crowdsourcing, and that in turn is directly and positively related to customer effective commitment, which is positively related to customer loyalty as measured by satisfaction, word of mouth, consumption, and the intent to switch. Both the ideation crowdsourcing and effective commitment are known as mediators. We'll talk about that in a little bit. The 2 up top, the experience that customers have in the crowdsourcing exercise and their professional status as either managerial or non-managerial, were hypothesized to moderate the relationship between ideation crowdsourcing and effective commitment. The research method, it was my unit of analysis was the individual. The population of interest was US adults who vacationed at least once a year, have stayed in a hotel during the past 24 months, and were responsible for making the decision about which hotel they stayed in. The design, it was a quantitative analysis. I used a validated online survey with a 5-item like-it response. I performed first an informed pilot and then 2 pilot studies in order to perfect the survey instrument. And then a lot of the data was analyzed using a variety of descriptive statistics, chi-square, analysis of variance, and different kinds of regression analyses. So this is sort of this high-level descriptive statistics, really from the standpoint of gender, geographic origin, age, income, nothing really remarkable. Oh, by the way, the full sample was pretty robust, 320 respondents. And since this status of either managerial or non-managerial was hypothesized to be a moderating variable, it could be of interest the fact that 65%, fully 2/3, classified themselves as being managers, and also the main purpose of the hotel stay, with the great preponderance being leisure, as well as the relatively few overnights over a 2-year period of time at only 1 to 10. That's a little bit of an anomaly, and we think it's probably because this was taken during and just after COVID. All right, so the good news, at least for my dissertation, was that 7 of the 8 hypotheses were supported. And they were supported significantly. The p-values, which is sort of a measure of statistical significance, all of them were less than 0.001, with the exception of one, hypothesis 7, that had a p-value just below the threshold of 0.5. The adjusted R-square, which is an indicator of the level of the variance in the dependent variable that's explained by the independent variables, ranged from 0.113 up to 0.465. Only hypothesis 6, which was that perceived experience of the crowdsourcing exercise, was not supported. Again, I mentioned I would come back to this notion of mediation and moderation. Mediation is an extension of the relationship between 2 variables. If the relationship, is the relationship direct, or does it pass through, or in other words, mediated by another variable? If so, the effect between the variables will be less than the total effect if a statistically significant mediator is involved. Moderators, on the other hand, they talk about the strength and direction of the relationship between 2 variables. Think about alcohol as being a moderator on one's ability to drive a car. The research model depicted that participation in crowdsourcing would mediate the effect of the independent variables on effective commitment, which in turn would mediate the effect on participation in crowdsourcing on customer loyalty. These mediating effects were proved to be statistically significant in all cases. They had p-values of less than 0.1. In addition, the positive relationship between crowdsourcing and effective commitment is moderated by one's status as a professional or a non-professional. Overall, the conclusion was that participation in product ideation crowdsourcing does enhance customer loyalty, at least in the US lodging industry. As far as theoretical contributions, which we have to do in academic research, it contributes to the theory by bolstering the importance of psychological factors in customer loyalty, as opposed to most of the research that really focuses only on buying behaviors. It supports further the effect of effective commitment as a mediating precursor to customer loyalty, and it demonstrates that psychological factors not only contribute to customer loyalty, but to participating in crowdsourcing. As far as practical implications, really a double benefit that hotel industry participants can reasonably expect that a product ideation crowdsourcing exercise will also enhance the participants' loyalty to their brands. And this is in addition to the traditional benefits associated with crowdsourcing, such as superior product ideas, sales and marketing premia, etc. There are limitations to the research. One of them is generalizability. This was done only for the US lodging industry, and so it doesn't necessarily mean that these results would generalize to other countries or regions or industries. The survey instrument itself, believe me, operationalizing these things, latent variables, is very, very difficult. And while a lot of literature was reviewed and numerous validated surveys were utilized, I think there could probably be improvement to the survey instrument itself, and this could be an area of future research. The direction and strength of the model, although the model said that participation in crowdsourcing would enhance customer loyalty, I recognize that it's also equally possible that if you are loyal, then you may be more willing to participate in crowdsourcing, and sort of feeding, a positive feedback loop could be created. And that could be another interesting area for future research. And then lastly, the perceived effectiveness of the experience. I really thought, and the literature indicated, for example, you participated in crowdsourcing exercises and you had a really negative experience, that it could end up having the opposite effect and actually decrease your loyalty to the brand, because after all, they kind of upset you. However, it was not supported, but that could be another, and it was a little bit contrary to literature. In addition to what I just mentioned in terms of areas of potential future research, I think that this study could be extended. I framed the respondents with what's called a vignette, where I explained that, and asked them to imagine that they had participated in a crowdsourcing exercise, explaining to them what it was. I think an experiment where you actually did take one group and submitted them to a crowdsourcing exercise and another that you didn't, and see what real impact it has on customer loyalty could be an area of future research, as well as structural equation modeling in order to really test the direction of the relationships. Is it only going, or does it also possibly go in the other direction, as well as which of the variables have the most effect on the dependent variable. And then lastly, looking at the same model but in other context, either other hospitality companies like cruise lines or airlines, and perhaps even looking in other industries. So that wraps it up. Thank you very much for your attention. And I'm going to ask Dr. Wu to come out. Dr. Wu, famous Steely Dan song.
All right, good afternoon. It's so nice to see all the familiar faces. I feel like we are in a very good business community, so it's very good. Slides? Oh, let's see. All right. Before I present, I want to ask you, how many of you had a coffee around noon for the lunch? Few, right? Okay, good. We're going to talk about very heavy academic research, and so better, if you have coffee, you probably have the patience to listen. I was joking. So this is the first time I present academic research in a business conference. So I'm trying to make my research more intuitive. Hopefully, we'll bring some useful information to you guys. So I will discuss two topics, and the first one is based on one of my research paper, Local Economy, Asset Location, and REITs Firm Growth. The second one, I will give you a brief introduction to academic research on property technology. So that's not my research, but I would like to give you a summary on what's going on based on academic research about property technology. All right, so the first paper, Local Economy, Asset Location, and REITs Firm Growth. And the basic research question in this paper is to which extent and how local economic growth and asset location will affect commercial property value. So in this paper, we use data from US REITs. So you guys heard about US REITs, Real Estate Investment Trust. They are a public company, and they're large. More importantly, they have a geographically diversified portfolio. So this allows us to relate the local economic growth in different regions to the property values of a REIT's portfolio. So in other words, we use REIT sample to study the impact on REITs firm growth because they provide a good sample for our study. All right, so the next slide I will talk about some intuition and some motivation for the paper. Why do we conduct this study and what is the intuition? So location, location, location. We heard this a lot, right? As real estate professionals, we know location is vital for real estate investing. And so, however, a big question is that where do you want to invest in property? Suppose you have $20 million to invest in commercial real estate, right? So you will say, I will create a diversified portfolio. I will invest in Sunbelt states like Texas or Florida. The question is that where do you want to invest? Which market do you want to invest? So, so that's a big question. That's why we want to conduct this study. One of the reasons. The second reason we want to conduct this study is that we all know, if I ask you, where is the demand for commercial properties? So many of you will say that's based on economic activities in the local areas, right? So exactly, if you think about commercial real estate, the demand for commercial real estate is really from the local economic activities. So that's why you know, some economists or some real estate experts will say, you know, it's important to pay attention to the local economic activities, right? So the intuition is very clear, and the asset location decision is important, and the local economic growth is very important because commercial properties provide space for economic activities, right? That's just very basic principle. So although the intuition is very clear, however, we don't have a lot of evidence based on systematic analysis using commercial real estate data. So that's why we conduct this study. Next, I want to talk about the research method very briefly. The question is that how do you measure local economic growth, right? So in this paper, we use local GDP data, local GDP growth rate. Why? Because it's simple and the data available, and we basically use the local economic growth rate to measure local economic conditions. Okay, so we find a very good data, and also we gather 423,000 commercial properties owned by REITs, and over this time period, 2001 and 2016. So we have a county level or metropolitan level GDP growth rates, and we also have a large commercial property data from REITs. So what we do is that we construct an aggregate or firm level GDP growth for each REIT. So I'll talk about that later, right? How do we construct that firm level GDP growth rate for a firm? So once we have this data, we have this measure, so we study how the firm level measure of local economic growth of REITs is related to their long-term firm value. All right, so this is a map for US GDP. I think it's based on 2014. So if you look at the different colors, it shows that the GDP growth rate. Here I use two REITs as example. So if you look at the REITs A, so there are 3 properties held by the REIT, and they're located in the Sunbelt state, Texas and Florida. And so we know that economic growth rates are high, versus like REITs B, they have property located in the northern part of the country. So what we do is we construct a firm level GDP growth rate is we basically calculate the average of GDP growth rate for that firm based on the property location and based on the property value of that REIT's portfolio. So essentially, we calculate average GDP growth rate for a REIT based on its property locations. So let me talk about the major findings. REITs firm growth measured by total value is positively correlated with the firm level economic growth measure. What does this mean? It simply means that if a REIT's allocating most of the assets or properties in a high economic growth areas, their firm value increase faster, okay? So it's very simple. It's intuitive. The next thing, we also find, if you look at, if you divide the firm value or total asset value by equity and debt, and what we find is the local economic growth enhance REITs growth mainly through equity, not through issuance of debt. So if you think about the total firm value, we have an equity portion, we have debt portion. So this result shows that the high firm value growth of REITs, for those REITs with a lot of properties in high economic growth area, and their growth actually is from market value of equity. It's not from when the firm can issue more debt, you know, sort of an expansionary path, right? So this shows that if you allocate to assets in high economic growth area, which means your firm value increase is because of equity. So it's more like real growth or organic growth, right? Also, we find out REITs with more assets in high economic growth areas provide higher stock returns to the shareholders. So that's another evidence to support the results. So what we get from this paper, right? The intuition or implications. So the paper shows that the local economic conditions is very important, right? And also asset location strategy is vital for firms' long-term perspective, even though the paper is based on REITs, the public firms, right? However, there are also implications from these results on the private investors. So what does this mean? It means that we need to pay attention, as a private investor, we need to pay attention to where do we allocate our assets in the long term. And also, we need to pick those high economic growth area. You know, in this case, we measure by GDP growth, right? So the next question is, how do I know which area has high economic growth, right? So now, that's why in the morning we have a panel. We were talking about, you know, you need to do your market analysis, you need to use your database STDB, you need to use CoStar. So you want to look at the historical data on GDP growth rate, okay? You want to examine demographic trends, okay, to forecast the future GDP growth. And also you want to study the industry development. So based on all of this analysis, you have a good idea about each area and in terms of economic growth. And also you should have a diversified portfolio. So that's the basic message for this paper. All right, next I'm gonna give you a quick introduction to academic research on property technology. I'm not an expert, but I did some literature review. I want to provide some information to you. It's changing. Usually, real estate industry adopt technology slowly, but now it's changing. So there are a lot of research, emerging research on property technology. However, due to lack of data, most of the research right now is still descriptive. So for me, I want to do some empirical research. I need the data, right? So, but I did some, literature review, try to understand what are current status of the literature. So there are few studies, and as I can, summarize here. So there's study on impact of technology on by using the property management. Okay. There are also some study looking at impact of technology on mortgage lending. And other research study the online listing portals, whether there are any impact on residential brokerage. And some other studies show the overall impact on digitalization. And finally, some studies show the survival rate of a prop tech company. So here I show you a little bit more details. In the 2021 paper, based on LB and B data in Spain. So they find adopting property management software will increase occupancy and revenue about 13% for the company, okay? However, interestingly, the daily rate is actually lower. So they argue that this kind of result is due to enhanced market transparency by using property management tool or software. Another paper in 2019 shows that the tech lenders, compared to the traditional banks, they increased their market value in mortgage lending from 2% to 8% during the period. And more importantly, the tech lender process mortgage applications 20% faster than banks because they use AI, they use machine learning. The last paper is based on a large data set residential houses in Singapore. They find out for the agent, if they use listing portals, right, they can increase the sale price about 3.26%. They can sell the property faster and shorten the selling time. All right, so the next paper, they did a summary on current conditions on property tech markets. And they show now globally there are about 7,000 plus prop tech companies around the world. And in Europe, in US, in China, India, property technology business or companies are booming. And based on 2018 data, there are $13 billion venture capital funding for a prop tech company. And guess what? Not this year, last year, the total venture capital available for prop tech company is $32 billion. So there's a very fast growing trend for prop tech companies. Finally, I will show you just another paper study successful rate of prop tech companies. So if you want to make any investment on prop tech companies, they actually lay out some factors and some indicators. So in this paper, they show the firm size, financing conditions are critical in success of prop tech firms. For example, if you have a multiple round of financing, and if you have a lot of number of investors over the lifetime, those are important factors. And finally, they give you what type of prop tech company you want to look for if you want to invest in prop tech. So what they find out is that those type of prop tech company focus on sustainability, technology, data, business analytics, and real estate related fintech, like lending and visualization. Those are very promising if you want to invest in startup company for property technology. So thank you so much. If you know any data, please let me know. I can do some research. Thank you.